Hello again and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is our market insights and observations for Thursday, July 11th. And we're going to talk about three topics. One, we're going to recap and provide a link for you on our CNBC interview that we had earlier in the week that teed up the CPI report that actually came out today. And I want you to watch that link as we actually discuss what was going to happen as it played out, and welcome news on the CPI report today because it came in a little bit cooler than what was expected, and that's much needed. But we're also seeing S&P and NASDAQ on record highs, this year to date. But we're also seeing other records. We just, let's roll right into it. We're in Palm Desert, California, coming to you from our studio in our office here. And just a few days ago, we had excessive heat warning, but more importantly, we made a all-time record high of 124 degrees. Now, I realize it's hot where you are, but it's not as hot where you are as it is here. So what does that mean? And everyone always wants to know what it's like to be in the desert in the summertime. Well, we just took a photo of a stop sign or a stoplight, and this is actually what happened right outside our office here, because when it gets hot, it gets super hot. Well, let's go back into the report for the day. Milder inflation keeps the door open for a September rate cut. On the CNBC interview, I basically said that Jerome Powell is putting down the landing gear in his most recent testimony to Congress, indicating that, yes, he is open, and more importantly, there's a balance between the inflation coming down and unemployment rising. And remember, he has to keep price stability as well as unemployment stable, and that's his dual mandate for the Federal Reserve. So as that's coming more into balance, he also acknowledges that there's more risks in the market moving forward. Therefore, I believe he then put the landing gear down, saying September's on the table. It's more of a 70% chance in the betting markets that we will see a rate cut. I think we'll also see another one, I believe, the day after the election, as well as November. So markets are pricing it in, but this is the CPI core and overall, and the trend is your friend. This is another CPI look, and it's one of the lowest reads in terms of prints that we've seen since the start of the pandemic, which is a welcome. What everyone's been looking for is inflation coming down, and that's what's much needed for the Federal Reserve to then start lowering interest rates, because that restrictive policy is slowing down everything because of higher borrowing costs. Now, inflation I've discussed this over this last year several times, and that is inflation comes in multiple waves. If you go back to the 70s, even before and prior, economic cycles repeat themselves, right? They're not exactly, but they tend to rhyme. So the question was, and the reason why the Fed was higher for longer. Keep in mind, at the end of last year, I was in New York and Bloomberg and on Fox, and I was saying very specifically, going into 2024, the Federal Reserve is going to keep a higher for longer mandate, and this is exactly why, because of this historical sort of economic backdrop, that what the Fed is worried about is because 87% of the time inflation comes in two waves. Now, these are all the other historical years, 1910, 1939, 1972. These are the waves that you see. And the blue wave right now is where we are in present day. So the real question is, will we see an uptick in inflation even higher than before, historically speaking? Now, in 1994, 95, we had a soft landing, and we actually got out of it. And that's when the markets took off. So we don't know which direction, but what Federal Reserve Chairman Powell is doing is being overly restrictive, overly cautious, higher for longer, and now shifting tunes. We believe he's going to actually, also help out the market by giving a rate cut. So hopefully this inflation rate stays down and moderate, and we don't see another sort of spike up. And what's also adding to it, again, in that interview with Frank Holland, I basically pointed out that there are some areas of the market that are interesting because even of the inflation picks. I mentioned Warren Buffett's Berkshire Hathaway. And the reason why is very specifically insurance premiums are surging. 30% of Berkshire Hathaway's portfolio is insurance driven. This is from the Wall Street Journal today. Insurance premiums are surging, and states are allowing it. 20% increase year over year. So you just follow the money, and that will, we believe, sort of translate into earnings. And then finally, record low percentage of stocks outperform the S&P 500 index. What this shows is the outperformance of the percentage of stocks. So all this is saying is that a small fraction of the stocks that are leading the market up year to date, think big tech. And that's what's happening. We've seen just a handful, about 7 stocks, that have really given us the majority of the returns here to date versus the 593 other stocks that are part of, there's 11 sectors in the S&P 500. So again, we have to see a broadening out. So we're going to see some money come out of big tech, which is healthy. And it has to broaden out and go into other areas like healthcare, financial services, industrials, materials, even real estate, all these other sectors for the markets to continue from where they are to move higher moving forward. So this broadening out effect. So as we see, if we see, and we have in the last few trading days, it doesn't mean it's a trend, but we're seeing money coming out of big tech and money rotating into all those sectors that I discussed. If that's the case, we will see this move back up into sort of more of a positive direction, more of a healthier, more balanced marketplace. That's our update for today. Thanks for watching. Again, like, subscribe, share with friends and family, and thanks for watching.